Joining us right now to talk about the durable goods data that we just got and the GDP and inflation numbers due later this week. Want to bring in former Dallas Fed President Robert Kaplan, and also want to get his thoughts on maybe the way the Fed should see this, will see this. I don't know if you want to take us inside the brain of Jay Powell to the extent you think you can do some mind reading for us.
Yeah, so I think this most recent durable goods numbers consistent with a resilient economy. And I think the overarching narrative in my mind is we have historically restrictive monetary policy being blunted to a great extent by historically stimulative fiscal policy. Unspent American Rescue Act money still being spent, Inflation Reduction Act projects, Infrastructure Act projects, and the conflict between those two has meant that particularly the services sector, inflation in the service sector has been stickier. Goods are disinflating. That's being helped by China overcapacity and particularly global overcapacity. But services, particularly labor, is where ground zero is of this inflation issue. And if I'm at the Fed, I think what they're thinking is we're at full employment and they can afford to be patient, and they do not want to make a mistake by beginning rate cuts and then having a resurgence of inflation, particularly in the service sector. So they're going to wait, and I think they're going to push back expectations for a rate cut and leave their options open for when they might act and the direction even that they might act. And it's because of this conflict between monetary and fiscal.
To the extent there's either a rate cut in our future, or maybe even, I think you're suggesting there's potentially even a rate hike in our future, you think this is now into a 2025 event?
I still think there's a chance that the Fed could cut rates in 24. They'd like to cut rates. It would be helpful to the banks. It would be helpful to small business. And also, you have a perverse impact on rents by having high rates, because it's very hard to buy a home. It's hard to build a multifamily rental project. Might actually be putting upward pressure on rents, I should say. So I think they're going to keep their options open. I think the bar is extremely high for actually raising rates down the road. But I think they're going to be patient, non-committal, and kick the can down a few more months.
So what do you think the chances are that they raise rates, though?
I still think it's extremely low.
Very low. Okay.
And I would far rather see the Fed, and they're loath to do this, call out the impact of fiscal spending. And I'd love to see a more whole-of-government approach to fighting inflation. And what do I mean by that? Slow down implementation of the Inflation Reduction Act. Slow down implementation of the Infrastructure Act. Slow down implementation of unspent ARPA money. Because if you leave it solely to the Fed to fight inflation, we're going to have higher rates for longer, and it's having distorting effects and other damaging effects to the economy, I think, over the long run.
What do you think, or do you have any concern about the employment picture as the year progresses? I mean, I think this is the issue that Jason Furman was raising earlier today.
I think as long as you've got this size fiscal stimulus, people got to remember, we ran a $1.1 trillion deficit for the first 6 months of this year. We ran a 7.5% deficit last year. That is historically high when you're at full employment. And these Inflation Reduction Act projects, Infrastructure Act projects, are stimulating demand for workers, and I'm seeing that all over the country. So, yeah, I think the labor market is going to remain resilient.
So just so we're clear, though, let me just flip this whole thing around. We're looking at equity markets right now, and I think there's still an expectation or some kind of grand hope that we do get a cut before the end of the year. If that doesn't happen, how do you think about the valuations that you're seeing out there?
I think there's still a chance for a cut this year. If that doesn't happen, got to remember the big platform companies like Meta, Amazon, NVIDIA, these are companies that don't tend to use debt. They're platform companies. I think those companies can still perform very, very well, even if rates are sticky. I think where you're going to see higher rates shake out is on smaller, mid-sized companies that don't have the size and scale and access to technology and are more sensitive to labor costs. I think they'll be disproportionately negatively affected if rates stay higher for longer. And obviously, anything interest rate sensitive will be negatively impacted.